In this video, we're going to cover short selling. So we're going to talk about what short selling is and how do you actually short a stock. So my name is Tyler Stokes from StokesTrades.com. I'm on a journey to become a full-time day trader. And in order to do that, I need to understand exactly how to short stocks, whether you use options or you just want to use this as a day trading strategy. It's really important to understand. And I know a lot of people sort of struggle with exactly how this works. I personally did as well. The concept is really easy, but there are a few things that seem to trip people up. So we're going to cover all of those in this video. It's going to be very beginner friendly. And at the end of the video, we're going to do an example so we really understand exactly how this works. Now, if you want to become a full-time day trader as well, I do have my 6-month blueprint, which outlines exactly what I'm personally doing in the first 6 months to pursue this career as a full-time day trader. And you can download that resource below this video. So let's jump into this and start discussing, what short selling is. So for this example and a quick intro sort of discussion, I actually used ChatGPT and Grok, the AI tool from X, to sort of come up with something that's a little easy to understand. And then we'll apply sort of this concept to actually stocks and investments and securities. So imagine you have a friend who has a really cool skateboard that you think will become less popular and lose value soon. What you do is you ask to borrow the skateboard for a while and your friend agrees. You then sell the skateboard to someone else at its current high price, hoping that in a few days or weeks, when the skateboard is less popular, you can buy it back at a lower price. And after buying it back cheaper, you return the skateboard to your friend, and then you keep the difference in price as your profit. So this is similar to how short selling a stock works. In the stock market, short selling, it's when an investor borrows shares of a stock from someone else and immediately sells them. Now, the goal is to buy the same number of shares back later at a lower price, return them to the lender, and then pocket the difference as profit. So it's like betting that the stock's value will go down. But short selling is risky. If the stock price goes up instead of down, you could end up losing a lot of money. So it's sort of very, very clear there. The only thing that was tripping me up that we're going to dive into right now is this whole notion of borrowing the shares and then returning them. So, who do you borrow them from? How does that work? That was a concept that sort of I was struggled with, and we're going to kind of go deeper into it here. So short selling, essentially, it's selling high and then buying low. So we sort of all understand this concept the other way around, where you buy low and you sell high. So you buy a stock, say you buy it at $100 and it goes up to $150 and you sell it. You've just gained $50 of profit. Well, with short selling, you're sort of doing it the other way around. You're selling high and then buying it back low. But the only difference is that you need to borrow shares and then return them to make this whole process work. So let's talk about how short selling works in the stock market, but sort of the behind the scenes with this whole notion of borrowing shares. So, you think a company's stock price is going to go down. So you borrow shares of that company's stock from your brokerage firm. And the brokerage firm, it has these shares in their inventory or from other customer clients that they have access to. So once you borrow the shares, you sell them at the current market price, and then you wait for the stock price to fall. If the stock price does fall, what you do is you buy the same number of shares back at a lower price. And after buying them back, you return the shares to the brokerage firm, to the original owner. And then the difference between the price you sold the shares at and the lower price that you bought them back at is your profit. Now, what you need to understand is that this whole process is seamless in your brokerage account. So when you short sell a stock through your brokerage account, the process of borrowing the shares and then selling them instantly, it's handled electronically and seamlessly behind the scenes. So that's how it works. So you don't need to like request to borrow the shares and then do some other action in terms of selling them right away. That's sort of all done behind the scenes. So initiating the short sale in your brokerage account, you're going to enter an order to short sell a specific number of shares of a stock that you believe will go down. And it's done through the simple interface. So basically, every brokerage dashboard is going to be a little bit different, whether you use like Webull or TD Ameritrade or Questrade here in Canada. But basically, what's going to happen is you'll have an option to either short a stock, or you might just have the option to sell a stock. So if you don't own a stock, you'll basically click sell for perhaps 100 shares. And what happens instantly is your brokerage firm goes and borrows those shares from someone else or from their own inventory and then immediately sells them for you. So you'll have the cash come into your account, and then you'll have a negative balance of how many shares you shorted. And what you need to do is just eventually in the future buy back the same number of shares, so they go back to the brokerage firm, back to the original owner, and then whatever that difference is what you make in profit. So I think that trips up a lot of people, this idea of borrowing the shares and instantly selling them. And again, it's done through the brokerage firm, through the interface. You either click short the stock or you just click sell the stock. And if you don't actually own any of that stock to sell, you're basically starting a short position. And your obligation now is to eventually buy back the same number of shares and return them to your brokerage firm. So when you short a stock, again, the process of borrowing and selling, it's all handled behind the scenes at your brokerage. So you might be wondering, why would the brokerage firm actually lend you the shares? Well, they are going to receive some interest or some fees for doing this. So the brokerage firm, they're going to charge you, a fee or some interest, and it depends on what firm you're working with, for you to borrow those shares. So you'll pay like a small percentage every month, and then they'll also do this because they have the stock available. They'll lend out shares that they already have sort of in their inventory, or shares of clients who have those shares at that brokerage firm. So in terms of risk, the brokerage doesn't really have very much risk because they're not exposed to the price fluctuations. The main risk for the brokerage is if you, as the short seller, if the price of the stock doesn't go down, it actually goes up. If you're not able to buy the shares in the future, then there is a little bit of risk for the brokerage firm, but they have things in measure to sort of counteract this risk called margin call. So we'll just talk really quickly about margin. We won't go into it in too much detail in this video. It's sort of a beginner sort of friendly video, but when you short sell a stock and the price actually goes up instead of down, you could actually start losing a lot of money. So if you short a stock and it's at $100 and it goes up to 150, over the course of many months or years, it maybe doubles, it goes up to 250 or 200, you now need to buy that share back at a higher price, and basically you lose that money. You need to buy it back more expensively and just return the number of shares. So there is a little bit of risk there. And, sometimes people have short positions for thousands and thousands or millions of dollars. So you can start losing a lot of money very quickly. If your losses get too big and you don't have the money in your account to cover the position, then the brokerage steps in with a safety measure called a margin call. So this is like an alert telling you to add more money or add more securities to your account in order to cover your potential loss. And if you can't do this, the brokerage will step in and they'll close out your position, buying back the shares at the current price, even if it means taking a loss. So there is that in place for the brokerage. So in terms of risks with short selling, you as the short seller, you bear the risk of the stock moving sort of against your position. Now, in terms of responsibility from the firm, from the brokerage firm, providing the shares for sale. So when the original owner, decides to sell some shares, so you've opened up a short position, you've borrowed shares from someone in your brokerage. If the original owner then wants to sell the shares, the brokerage firm is responsible for just supplying those shares to the person who wants to sell them. So it's never a situation where you've borrowed shares from someone and now they don't have access to those shares and they can't sell them. So that won't happen. Your brokerage will have access to the shares if one of their clients needs to sell them. So that's their responsibility, replacing the borrowed shares and then having shares available when any person wants to sell them. So, to hammer home this point, when you borrow and sell shares in a short sale, the original owner still owns their shares in terms of, market value and rights, even though those specific shares may have been sold in the market. When an original owner decides to sell their shares, the brokerage firm ensures a seamless execution of the sale, even if those shares are currently lent out. So then you might kind of ask yourself, with this whole process, how it works, did you agree to ever lend your shares out? Well, when you open an account with a brokerage, there's usually going to be some terms and service that you need to sign. And these will include a clause that allows the brokerage to lend out your security. So it doesn't apply to all accounts. Here in Canada, with a tax-free savings account or an RRSP account, I believe that shares can't be lent out. But if you have a margin account where there's borrowing going on, then you might agree to lend your shares out. And there's options where you don't need to, or then you can actually. And there are some benefits as well, because not only is the brokerage going to earn interest or earn fees through people who are short selling stocks because they're borrowing them, you as someone who actually ends up lending out your shares through your brokerage may actually receive some funds as well. So if you own a lot of stock and your brokerage lends out your shares to someone who wants to short them or open a short position, then you potentially might earn some money as well. So basically that sort of goes over exactly some of the things that I was personally not understanding in terms of short selling. I really understood the whole notion of, selling high and buying low, and there's that profit difference there, but I wasn't understanding the whole notion of where do you get the shares from? How do you borrow them? How do you return them? So hopefully what we've covered there sort of explains that well, and now you have a better grasp of exactly how that works. And in terms of why people short stocks, we're going to run through an example right now. But typically, you expect the price to fall. So whether you believe the stock's going to go down and you want to take a position to earn that profit, this is when you would open a short position. Many people might feel that some stocks are overvalued, and they're valued higher than the company's actual value. So they short sell the stocks, betting that the market's going to come around and figure this out eventually, and then the price will come down. And then there's this notion of hedging. So some investors short as well to protect some of their other investments. If they think the market might go down, short selling can kind of help balance out some losses in terms of their other investments. So, just to wrap it up before we get into our example here, short selling, it is like the reverse of the usual process of buying and then selling. Instead here, you sell first at a high price and hope to buy back later at a lower price to make a profit. And again, people do this when they think a stock's price is going to fall. And again, I think we covered quite well how that works in the back end of your brokerage account. It's a seamless process of borrowing the shares and instantly selling them. So let's do an example here, and I'll pull up my whiteboard after we go through this example. And we're going to go through this scenario that actually happened. It's sort of like the fall of the Nikola Corporation. So you might be familiar with the Nikola Corporation. It's a electric truck company, and had some other supposed technology regarding fuel cells. Well, Trevor Milton was their founder, and he was found guilty of fraud and sentenced to 4 years in prison. He basically made false statements about the company's technology and future sales prospects, and that pumped up the stock price. He claimed that Nikola had developed a working prototype of a hydrogen fuel cell powered semi-truck called the Nikola 1, but in reality, the truck was not fully functional and was not powered by its own propulsion system. There was actually a video where their demonstration video had the truck sort of rolling down a hill, and the hill was actually the thing that propelled, or the thing that powered the truck forward. It didn't actually work. Milton also claimed that they developed some other breakthrough battery technology that would, double the range of electric vehicles. And basically this did not exist. So this fraud sort of broke out in September 2020 when there was a report from this Hindenburg Research, which is a short selling investment firm. They sort of exposed many of the company's false claims and misleading statements. And after the scandal broke, the Nikola stock, it started to plummet. So I remember hearing about this story, and I remember saying to myself, hey, maybe I should short this stock. And I never did. And looking back in hindsight, if I did, I would have made money. But here is the graph, and we'll just run through an example of how, if I did take on a short position in September 2020, what the math would look like. So I'm going to jump over to my whiteboard now, and we're going to run through this example really quickly. Okay, so in September 2020, the Nikola stock was trading at $35. So if we sort of have a graph here, and maybe we can just call this September 2020, and the stock was up here at $35. Okay, so if we want to short this stock, we believe that the stock price is going to fall. So we want to take out a short position. So let's pretend that we take out a short position for just 100 shares. So what would happen is you would short 100 shares in your brokerage account. You'd either click short in your dashboard, or you would just click sell. And if you don't own any Nikola shares, then you'll get a pop-up that says, you're going to open a short position, and you click OK. And the price is $35. So what would happen is you will gain $3,500 in your account, and you're going to have basically a negative 100 balance of Nikola stock. So the scandal breaks in 2020. You believe that the stock's going to go down, and it actually starts to plummet over the next few months and all the way into our present day. And we're talking early 2024 here. So what you would do is you can cancel your short position anytime. But if we want to say, perhaps we let the stock fall and we want to close out this position now, and the stock's actually all the way down at 70 cents. So the company's actually doing quite poorly given all the fraud and the scandal that happened. So what we want to do now is close our short position. So we need to buy back this negative 100 shares in our account. And in order to do that, we go to the market, and the market price is now 70 cents a share. So that's $70. So in terms of how much profit we make, basically it's our initial sale. When we shorted the stock right away, we borrowed the 100 shares and we sold them at the market for the market value of $3,500. And now 4 years later, or 3.5 years later, we want to get rid of our negative balance. We want to close our short position. So we buy the 100 shares back now at only 70 cents. And you can see that we have basically profited $3,430. And we have basically bought back the 100 shares. So we don't have any short position of stock, and we're up $34.30 in our account. Now there will be some interest and fees. So this is not going to be this much. You would have had to pay to have this borrowing this for the 3.5 years, but it wouldn't be too significant. But you can just see here, you've almost made 100% on your money over 3.5 years, basically because the company's almost gone down to zero. But that is the math behind how to short a stock. And you can hold these positions for years, as in this example, 3.5 years, and then you close it out. Or you can short on just an intraday. So within the same day, if you're doing day trading, you might want to do that, or you might, wait a couple weeks or a year or whatever. So that's how it works. In terms of risk, it is a little bit risky because, if Nikola company, for whatever reason, the stock started to go up, remember, you always need to buy back the same amount of shares that you borrowed. And if the stock has gone up, you would have need to buy them at a higher price and then return them, and you basically lose on the difference there. So that's how it works. I hope that this video was useful for you. Please subscribe to this YouTube channel if you're interested in more beginner-friendly tutorials like this. And if you are also pursuing a career as a day trader, we're going to discuss more about day trading specifically. We're going to get into options in future videos. We're going to set up a brokerage account. We're going to paper trade. We're going to do technical analysis and everything we need to do to pursue a career as a successful day trader. So again, I hope you found this useful. Subscribe to the channel, and I will see you in the next video.